Welcome to Lesson 8. This is the second part in the three-part lesson about insurance. We will cover life insurance as well as disability insurance in this lesson. Hope you're prepared because this is a pretty long one and pretty detailed one. Hopefully it's fun though. Now, take a second to review the different forms of risks that we identified in the first lesson. In this lesson, we will focus on the loss of life and the financial impact it has. We will also focus on the loss of means to gather more assets or support one's livelihood due to disability. Now, it's important that you understand the word indemnification. To indemnify, it means to make whole again. This is a very commonly used term in the insurance world. Most insurance policies are meant to indemnify against the loss. If you actually read the contracts, you'll see that word tossed around a lot. However, life insurance is generally not considered to be an indemnity insurance policy since you cannot completely restore the situation to the way it was before the loss of life. This is especially the case if you add all the monetary, emotional, and all the other aspects that exist within, that are associated with one's existence. If someone is dependent on you in some capacity, they are said to have an insurable interest. Conversely, if you have a financial dependence on someone else, you have an insurable interest on them. It's possible that you have an insurable interest on multiple people simultaneously. However, it's also possible that multiple people have an insurable interest on you at the same time. Let's think about a typical nuclear family with 2 parents and 2 children. Let's assume one spouse works and the other one stays at home taking care of the children. The insurable interest, or financial dependency, the non-working spouse has on the working spouse is everything from the basic needs of food, shelter, and all the other items that are required to sustain a lifestyle, and even includes things like the ability to accumulate assets for retirement and all their long-term goals like college planning and things like that. Conversely, the working spouse has a financial dependence on the not working spouse because that spouse, the not working spouse, may help manage all the household items, take care of the children, and all the other aspects that free up the working spouse in order to earn an income. And of course, the children in this example have a dependency on both parents, since they each have each receive a service, if you will, from each of them. So in other words, each parent has 3 insurable interests on them, one from the other parent and one from the 2 children each. Now, I have this chart here, it's a very simple graph, showing the relationship between the cost of insurance and time as well as the adverse health factors. On the x-axis going up and down, you see cost. On the y-axis, you'll see increases in age as well as adverse health factors. The idea here is to demonstrate as you get older, the cost of insurance, life insurance that is, goes up. Generally speaking, if you were to look at identical policies of 2 people with different ages but the same health profile and gender, you would see that the older person pays more. Typically, age is one of the biggest factors, but other factors can make a pretty big difference as well. For instance, if we look at rates for men and women of the same age and same health profile, we would find that life insurance costs for men are actually a little bit higher. This is because men have a lower life expectancy than women. And I've heard all the jokes about this, so please let's not make any more. Another factor I keep referring to is the health profile. This is a kind of a complicated item because it includes things like, well, personal health history, tobacco use, history of tobacco use, alcohol use, family health history, driving records, and hobbies. Personal health history can include things like your weight, your cholesterol, your height, your blood pressure, your diseases, injuries, or any sort of things that relate to you specifically that could increase your risk of mortality. If a life insurance applicant is found to have a driving record with multiple violations, such as a drunk driving, multiple excessive speeding tickets, or accidents, they actually may pay a higher amount they may pay a higher amount for the same amount of insurance than if they didn't. I mentioned family health history. This is things like knowing how old your parents were, or when the applicant's parents were, when they passed away, what they passed away, what caused their death. So was it cancer? Was it old age? Was it a car accident? Things like that. Those kind of factors may determine the insurance company's decision as to how much the insurance should cost. Something like a car accident probably wouldn't make a big difference, but cancer, if your direct parents have cancer, they may consider that. I mentioned hobbies. Hobbies include anything from motorcycle riding, motorcycle racing, scuba diving, foreign travel, hang gliding, skydiving, bungee jumping, or even recreational airplane piloting. Things like this may increase your cost as well. They may not seem risky or dangerous to you, but the insurance company may want to see that and, again, factor that in for your cost. Things like recreational drug use or what's considered excessive alcohol consumption can actually increase your costs as well. And in a lot of cases, it may actually preclude somebody from obtaining life insurance at all. With all this said, each person applying for life insurance may have all the aspects reviewed. As I mentioned, age is a pretty big factor, but it's not the only factor. It's possible that a cigarette-smoking 31-year-old in pretty good health pays more than a non-smoking 40-year-old that's in excellent health for, again, the same life insurance kind of policies, death benefits, things like that. Now, in purchasing life insurance, one of the factors determining what kind of policies you get is the amount of time that you'll need that insurance for. The question is the need or desire to have insurance strictly for a temporary basis, such as 10 years or 20 years, 30 years, or is the need for insurance or the desire to have insurance intended for a lifetime? The question is, do you want to make sure you have insurance for only 20 years, or do you want to make sure that you have life insurance all the way to if you live to be 98 or 100? When you purchase insurance, your premium amount is determined by reviewing the time involved. For instance, if you purchase term or temporary insurance, you are essentially averaging out the cost of insurance by the term you are committing for. A person looking at a 10-year term policy or a 20-year term policy should expect to pay more. The person looking at a 10-year term policy should expect to pay more than somebody that's purchasing a 20-year term policy, substantially more. That's because if you look at this chart, a 10-year term policy just is averaging out 10 years of coverage. As the cost of insurance goes up, those extra 10 years would bring up your cost, your average cost. And of course, 1-year term policy or a 5-year term policy would be substantially less than, again, a 10-year term policy or a 20-year term policy. The maximum I've seen currently is 30-year term policy, for those of you that want to know. Now, when you're purchasing permanent insurance, you're essentially locking in your coverage from your current age all the way to an age very far from the distance that an insurance company determines. It could be 95, it could be 100, it could be 120. Again, you're averaging out from current age all the way out to possibly age 120. Since you're averaging out the cost over a much longer period of time, and since the costs rise over time, you should expect to pay substantially more for a permanent policy over a term policy. I think it's important to understand that, in the term versus permanent world, I don't believe there's a one-size solution that fits everybody. Some consumers believe that term policy is the only thing that you should purchase. You should only purchase 10, 20-year term. You won't need insurance down the road. However, for some people, that's not the case. If you're covering if you have a newborn, let's say, and you want to have life insurance, as long as they are a minor, maybe a 20-year policy may work for you. But some people wish to leave a legacy. If you wish to leave a legacy and you want to make sure that you have coverage for your entire life, that's when a permanent policy would probably make more sense to check out, because again, it's going to be there no matter how old you are and you're paying for it. Another factor is estate taxes. If you have substantial assets, or if you have a small business, a lot of real estate, or any sort of assets that aren't liquid or easily accessible for cash, a permanent policy may make sense because again, that way you have the policy no matter how old you are. So, with this chart here, I've tried to demystify the different kinds of insurance products. The chart essentially outlines the different choices that are available in the consumer market here. Now, this is only meant to be a guideline. Some insurance companies may have nuances in their insurance products where they don't really fit directly with this chart, but it's important to understand that you should read the fine print and be careful, because the fine print may actually indicate you think you're purchasing a term policy when you're purchasing something that's more permanent. You may be purchasing you may think you're purchasing a permanent insurance policy, and it's really a term policy. The phrase death benefit on this chart may seem like two words that don't belong together. However, what it means is that the amount that's paid upon the insured person's death. For temporary needs, term insurance is your only option. Term insurance may be called pure life insurance, as it acts just as pure insurance. It acts just like your auto insurance or any of the other insurance products you may be familiar with. The idea is that as long as you pay a premium, you are insured and you have a death benefit. If you stop paying premium, your policy will go away. In the case that you exceed the maximum term, it's important to know you may not be able to pay a premium anymore. So, what this means is if you purchase a 20-year term policy and you finish the 20 years, you're essentially in your 21st year, some term policies will not let you continue to pay into it because they don't want to take that kind of risk. They say the policy is done, your transaction is complete. Some insurance companies will let you continue to pay. However, it's important to know if you've purchased, let's say, $1 million term policy, you're paying $100 a month into it, you exceed the 20 years, let's say you have a terminal illness now, and you still want to have the insurance in place, they may give you the option to keep paying for it, but the $100 a month that you're used to, it's predetermined on the schedule in your contract, but the $100 a month may jump up to $500 a month, $600 a month. It's going to jump up substantially because now you've exceeded the number. They also know that typically insurance companies are well aware that if you are paying for it in your 21st year, you may not qualify for insurance somewhere else. So again, they're going to use that as an opportunity to lessen their risk. I keep using the word typically because, again, all these things may change, but very simply put, with a term policy, it's pretty straightforward. You pay a certain amount a month every month for a specific death benefit. Neither one of those numbers should change. The premium shouldn't change. The death benefit shouldn't change. There's no cash value component either for term policy. What that means is there's no account essentially that's growing within your life insurance policy. For those of you that want insurance coverage that will last your entire lifetime, the world of permanent insurance offers quite a few different products. Term is very straightforward. Permanent has different options. All permanent products have what's called a cash value component to them. This is like an account, again, that grows. The difference between the account, or your cash value, and the death benefit that you're paying for is known to the insurance company as the amount at risk. This means that if you've accumulated $10,000 in your life insurance policy and you have a $100,000 life insurance death benefit, the amount at risk is $90,000. So essentially, in that year, your life insurance would be charged within the policy for $90,000 of life insurance. Over time, let's say now you have $50,000 in your $100,000 life insurance policy. The amount at risk is $50,000. The policy charges inside would attribute to purchasing $50,000 of insurance. The cash value inside your policy grows on a tax-deferred basis. This means there are no taxes on the growth of your cash unless you withdraw growth from the policy and your policy ceases to exist. This could be because you canceled your policy or the insurance company closes the policy for insufficient cash or premiums. So in the example where you've put in $25,000 over your, let's say you purchased a life insurance policy at 30 years old, and all of a sudden now you're 60 years old, you've paid over your lifetime $40,000, I'm sorry, let's say you've paid $20,000 into this policy, you now have $40,000 in the policy, you begin to withdraw that cash, and let's say you withdraw $30,000, so again, follow me, You put in 20, you withdraw 30, and you decide to cancel the policy, you would be taxed on any growth that you've been pulled out, that you've withdrawn. If you do not withdraw any cash, if you let the policy continue to grow, continue to do its job, there's no tax consequences. But again, if you pull out growth and get rid of the policy, or the policy ceases to exist, you are taxed in the year that the policy is now no longer in effect. As far as universal life and variable universal life, they offer a little more flexibility as compared to whole life. So with whole life insurance, the death benefit is typically fixed. It's possible that the cash value of the policy may offer dividends that can be used to purchase more insurance, thus increasing your death benefit. But typically the amount you pay, the premium, is fixed for the entire duration of the policy. For example, you may pay $2,000 a year for $500,000 of insurance from now all the way into the year you pass away. However, you may also be able to structure your policy so you pay it up early. So let's say you have a paid up policy at age 65, your policy is paid for, you don't need to keep putting money into this policy. It's all determined kind of when you set the policy up with your agent. Universal life, unlike whole life, has flexibility. You can increase, decrease your death benefit. You can increase, decrease the premium that you pay. You can decrease your death benefit within certain limitations if you wish to save your premiums. So if you purchase, let's say, $500,000 life insurance, and of universal life that is, and 15 years go by, you don't need $500,000 of life insurance anymore. With universal life or variable universal life, you can actually decrease that from $500,000 to whatever the policy will let you do, the contract lets you do. That could be $400,000. It could be even lower amount as well. This could essentially help you pay less into the policy. It would make your cost of insurance less as well within the policy. Again, there's flexibility with that. If you wish to increase your death benefit, some companies will let you do that. However, generally speaking, they may require you to go through underwriting again. They're going to want to know why you want more insurance. If they didn't require you to go through underwriting, essentially somebody could, sign up for $1 million life insurance, 5 years later, get terminally ill, decide that they're going to increase their death benefit to $10 million. The insurance companies are much too smart for that to let that kind of thing happen. As I mentioned, there is flexibility in the premium that you pay. Universal life and variable universal life have this feature. You can increase or decrease your premiums within a certain range. Now, the minimum premiums and minimum cash value numbers are dictated by the insurance company. The insurance company would not want you to put $1 in for a $100 million life insurance policy, as the risk trade-off would not be fair at all. On the other hand, the IRS dictates the maximum you can pay into a permanent policy. This is because the aforementioned tax deferred cash value. The IRS does not want somebody to pay $2 million into a $1 million. I'm sorry. The IRS would not want somebody to pay $2 million of cash into a $1 million death benefit life insurance policy. That's because the insurance company then would not have any money at risk. There wouldn't be any sort of cost of insurance, and that $2 million within the policy would grow tax-free each and every year. The IRS does not want you to completely avoid taxes. So again, the floor is dictated by the insurance company. The ceiling is dictated by the IRS. Let's come back to this chart though. You'll notice that the only difference shown here between variable universal life and universal life is the cash value's growth component. With universal life, the cash value inside does not really fluctuate in value. It can increase, but it can't really go down a whole lot as long as you're paying properly. The growth is just interest credited with rates that are similar to current bond rates. There's typically a minimum guaranteed interest rate as well. If interest rates rise, the percentage of interest credited inside the policy may increase as well. But again, it'll never go below the minimum guaranteed interest rate. The burden to invest and grow the money is placed squarely on the insurance company. The insurance company assumes the risk, and provides a fixed rate of return despite their internal investment's performance. So it doesn't matter how they're investing the money, they're on the hook to give you a certain interest rate that they've promised. With variable universal life, the risk to invest and grow the money is placed squarely on the owner of the policy. The owner is provided with an investment menu similar to 401k where they can choose to invest however they want. In my experience, I've seen a minimum at least 15 to 20 different choices that somebody can invest in. These investment choices are pretty diverse. They'll let you invest in large U.S. companies or international companies, government bonds, corporate bonds. You have a pretty wide variety of investment choices within most variable universal life policies. However, again, the risk associated with investing, the burden of investing, all of that is squarely placed on the policyholder. With this said, just like a 401k, just like any other investment, it's important to note that a variable universal life policyholder may lose cash value within a policy if the investments perform worse than expected. A policyholder in one of these policies must be willing to assume a substantial amount of risk. In other words, they should be a pretty aggressive investor. They should also be somewhat aware of their investment choices, and they must be continually reviewing the performance of their account. It's possible that they can do really well, that is true, but again, it's also possible that they can lose money. These are just important things to understand when purchasing life insurance. Now that we've covered life insurance, let's talk about another morbid conversation: becoming disabled and unable to work. Have you ever thought about what would it be like if you or a breadwinning spouse were unable to earn an income due to disability? Has it ever happened to you or someone you know? It's pretty common. I mean, people don't think about it, but surgeons, for instance, their hands are very valuable. Even as small as injury could prevent them from earning an income. Computer programmers, all these people have very, very specific needs that a disability could substantially hamper their ability to earn an income. Now, there's two important factors to consider and understand when you are looking at or considering disability insurance. First, the probability of becoming disabled is substantially higher than the probability of an untimely death. Secondly, and I don't mean to sound flippant or insincere about this, an untimely death within a family typically results in expenses going down by 20% or even a third. However, a disability would actually cause the expenses to go up when income is now limited. So in other words, when people pass away, typically they're gone, expenses go down, but if they're disabled, unfortunately, their ability to earn, they're still around, they're still incurring expenses, and now their income is now limited as well. A third factor that a single person without any dependents may not feel the need to acquire disability insurance. They may think that it's not a big deal. There's somewhere else, there's some other options. They don't have any dependents to worry about their income supporting. However, if you think about it, they themselves are their biggest asset because they don't have anybody else to go out and earn an income for them. Their income powers their lifestyle, it drives their goals, it basically moves everything forward for them. Therefore, in my opinion, a single person that's untethered, doesn't have children, would still require disability insurance for the same reasons, if not more, than a married breadwinner could. Many married couples say, well, if one person would become disabled, the other spouse will just return to work. That may or may not be an appropriate response, depending upon the ability of income that this other non-working spouse could generate, the expenses that would be incurred, all these factors. Now, it's important to know that in this discussion, I'm talking specifically about income protection from a disability. This is a policy that systematically replaces your income on a reoccurring basis. This is not to be confused with a policy that offers a one-time payout due to disability or merely pays your hospital bills. A disability policy, as discussed here, is meant to provide ongoing income if you are disabled. If you have a policy already that you think if you have a policy that you think of as a disability policy, it's important that you review it to understand if it replaces income on an ongoing basis or provides a one-time payment or just a few payments in order to cover hospital bills and things like that. Disability insurance will only pay a benefit if disability insurance will only pay a benefit less than your actual pay. It's rare to see a maximum disability coverage that covers over 75% or 80% of your income, since no insurance company will fully replace your income. If you think about it, this could send out the wrong incentive to people. When figuring out disability insurance options, you will want to consider both long-term insurance as well as short-term insurance. Short-term disability covers the short term, typically no more than 1 year. You may need to have income beyond that period of time, and if that's the case, if you're disabled for more than 7 days, that's when you typically would begin receiving benefits. This is because you are more likely to be disabled for a short period of time. You may find short disability insurance is slightly more expensive than long-term disability, especially if your waiting period is 7 days and your maximum duration is only 1 year. This means you need to be disabled for at least 7 days in order to receive benefits. The shorter the waiting period before receiving a benefit, the more expensive your policy would be. Meaning, if you're willing to self-insure for 30 days versus 7 days, that could decrease the cost that you pay. Again, because the statistics of you being disabled for 7 days is higher than being disabled for more than 30. And again, the further you push that out, the cheaper the policy becomes because your coverage is less. Some people choose to retain the risk for short-term disability because between their emergency funds, between their spouse's ability to earn an income, and access to other financial resources, a short-term can be covered. They may not get disability insurance for a short-term period of time. Some people choose to transfer this risk by purchasing a policy, again, a short-term disability policy. On the other hand, a long-term disability is a financially catastrophic event, and most people are unable to self-insure for this long period of time. Being able to self-insure against a long-term disability would mean that you are already financially independent and we would be able to retire comfortably tomorrow. A long-term disability covers the rest of your working career, either up to age 65 or up to age 65, 67, just dependent upon the policy. Some policies, like I said, may cover from 65, some may cover 67. The chances you're disabled for more than a year are certainly less than being disabled for a short period of time. Therefore, long-term disability may be a little less expensive, but again, it's a little more important, I think, because you cannot financially cover yourself in that kind of catastrophic event. Let's talk about group insurance versus individual insurance and kind of demystify that as well. Some employers offer a disability plan as part of their suite of insurance benefits alongside health and life insurance. This is known as a group policy. Again, any sort of employer-based disability insurance. Group policies are typically integrated with Social Security benefits. This means if you are disabled and eligible to receive disability income payments from Social Security or another service, the benefit from the insurance company would be reduced pro rata by any other source, again, with Social Security or what other public benefit would be paid. Group policies are not portable. This means if your employment ends with your employer that offers a group disability insurance, the policy cannot follow you to your next employer, or you can't follow you during unemployment either. It's very common that group policies only pay a benefit if you are deemed unable to work at all. This means you only receive a benefit if you're unable to do any occupation. If you are a physician and unable to practice medicine, but you can work in an office, you are not eligible to receive a benefit in any occupation policy. Again, if you have a group policy, you should review it to avoid any sort of surprises at a time when you wouldn't want any surprises. Having an individual policy means you've actually applied through an insurance company, gone through some level of underwriting, and accepted an offer. Just like all the other insurances that are out there, we've talked about life and property and casualty. This is a unilateral contract in that as long as you continue to pay, you are covered. If you apply for a disability policy while employed under one employer, but then terminate, your individual policy may not be affected at all. Unlike group, like I mentioned, the second you terminate employment, that's when your group policy goes away. Individual policy, as long as you keep paying for it, you are covered. You may be able to keep that policy for as long as you want, as long as it's in force, as long as you're paying for that coverage. This means the coverage is portable. Typically, individual policies are not offset or reduced by Social Security or any other benefit. However, you must review your policy to know that for certain. A large advantage that individual policies may offer is to offer what's called own occupation coverage. This means if you are unable to perform your specific normal job duties, even if you're able to work another job, you may be considered disabled and eligible for a benefit. You may be able to choose not to work. Professionals like dentists, surgeons, physicians, they get these kind of policies all the time to protect their high level of income that still allow them to be functional and able to operate, be functional and able to live life normally, but they're not able to perform their specific job. That way they're not forced to do some other work. Some policies even let you perform other work as long as it's not the same work you are covered for. Other activities that in this case could be things like teaching or consulting, things like that. Since own occupation offers a higher level of protection over any occupation, coverage would be more expensive even if all the other aspects of the policy, such as elimination, duration of coverage, all these things could be the same, but simply because your own occupation is protected versus any occupation, own occupation coverage would be more expensive.